Hi, this is Dustin with Dustin's Dollars. Today I'm going to be talking about Tellurian. I updated my Driftwood LNG rough valuation model to sort of a V2. I'm going to be going over that today and walking through the model and the assumptions that are baked into it. And there is a copy of a link to this down in the description below. You can make your own copy and plug in your own numbers if you would like to. Before I begin, let me remind you that I am not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in Tellurian, so this video should be for your entertainment purposes only. Because I could be wrong about everything I say in this video, you need to do your own research before making any investment decisions. So, I published a video a bit ago, I don't know, in August, I think, about a model for valuing Tellurian, Driftwood LNG phase one, and I wanted to update that with some of the changes that have gone on. And this is going to be, let's say, have even more assumptions put into it than the V1 model did, because we have sort of less certainty around what things are going to look like with Tellurian. But I wanted to walk through my assumptions, at least put together a model, so you can, even if what you think is going to happen is wildly different, hopefully this gives you the line items that you can make your own copy and put in the numbers and come up with what you think is a see what the valuation comes out with, at least from this model. So that is the intent for this. I'm going to go ahead and walk through it right now. Hi, Transient Stacker. Thanks for hopping on the stream. All right, so going off from the top down, right? Starting off, there are just some overall assumptions that I have, and a lot of these were pulled from the most recent investor presentation. There's one, just published this month in November. And so total cost for Driftwood, $13.6 billion. I assume they've already paid about $100 million of this. This is from their most recent 10Q. Pulled that number there. I calculated their current share count as fully diluted in millions of shares as 662 million. And this is treating that current convertible debt that they have as if it gets converted into shares. And then I also put this line item in here for how many more shares do you think will be issued between now and when Driftwood LNG phase one begins operations. And so for this one, I sort of made up a number, assume, hey, maybe they'll give out 20 million more shares for stock-based compensation or whatever else between now and then. Then these right here are starting to get this, or these two items here are huge assumptions that I really don't know what's going to happen, right? We're all kind of waiting to find out what this is going to look like. To my knowledge, nothing has been announced or even any concrete rumors. But the issue at hand, right, is what percent of Driftwood is Tellurian going to sell to an equity partner, and then how much cash is Tellurian going to receive in return for that stake in Driftwood. And I think Sharif did come out and say, hey, we intend to sell like 35% of Driftwood. So I have this 35% here. Now, as far as what valuation they're going to get from this is a humongous unknown. I have no idea. I plugged in a number at about $4 billion, and I just got that from roughly, I sort of worked into this number from looking at what is the total cost for Driftwood LNG phase one. What would 35% of that be if they were trying to sort of match this up here? And that would come out to about $4 billion. Again, feel free to put in whatever number you think is appropriate there and see how that impacts everything else here that I have. Then I looked at how much cash do they currently have that they could put towards Driftwood. They currently had about $600 million of cash on their balance sheet. And, I assume, just for the sake of simplification, I assume that all of that could actually be spent towards costs on Driftwood. And I think this is fairly credible if you just assume that their operations, their gas operations, would sort of fund the company in the meantime. And so all this money could actually go towards Driftwood. All right, so those are the starting assumptions here. Then I have just the rough, these are all computed numbers. This is my notation, by the way. Everything that is an underlined number here is actually computed from some of the other numbers that get plugged in. And the numbers that are not underlined are numbers that are expected that you need to provide to the model. So if the total project cost, this is just carried from above, is 13.6 billion, and if they get 4.6 billion as the sum of both the $4 billion they get for selling a stake to an equity partner, and then the $600 million of cash that they currently have. Then the remainder would have to be funded by debt. That would be $9 billion, given those assumptions. And just as a point of reference, that would mean the overall project was financed about 2/3, right, 66% with debt, which I think is right around the bounds that they have indicated in the past they are targeting. So moving down, I have a whole section with all of my assumptions about their feed gas here. And this hasn't changed much from my V1 model. So if you looked at that one, this is pretty much the same. But I am looking at it's changed slightly in the sense that I assume, and this is a huge assumption here that I have as well. I assume, maybe I'll have to jump down here just for a moment. In terms of their LNG that they're going to sell, I assume that they are going to sell 65%, that they're going to have ownership of 65% of phase one in terms of the actual volumes. And that may or may not be true depending on what the deal is that they strike with their equity partner. That 35% might not be 35% of each phase. It might be, sort of front loaded in the sense that the equity partner might get more of the volumes from phase one. We don't know. But right now I'm making the assumption that Tellurian retains 65% of those volumes in phase one, which would mean roughly about 7 million tons per year. And so if I assume they're going to sell about 7 million tons per year in terms of, LNG that Tellurian actually owns, rather than just, they just hand it to the equity partner at cost, then I'm only looking at feed gas for 7 million tons per year, which comes to about, just under 1 BCF per day. So if I look at that and I assume, well, they're going to have about 0.4 BCF per day in terms of their own gas production by the time that Driftwood would be operational, then, and I assume that they can source this at about $2.50 per MMBTU, then, they have to actually, it costs them, what's this, $370 million per year to produce that gas. And then the remainder, they have to purchase 200 BCF per year. And at an average, purchase price of $6, that's $5.50 for the actual Henry Hub estimated price, and 50 cents for pipelines. That means that they're spending about $1.2 billion per year in feed gas costs. And then, total, you just add up, line 2021, the cost of the gas that they are producing and the cost of the gas that they're purchasing. That gets us to just over $1.5 billion per year in terms of what they would spend to get feed gas. So hopefully that's clear. Again, feel free to put in your own numbers here when you're walking through the model. Now, for what Tellurian is going to sell in terms of liquefied natural gas, I assumed it was split 50-50 of the 7 million tons per year that I assume they're going to have in terms of their owned volumes from phase one for Driftwood LNG. And I again divided that 50-50, so it's 3.5 million tons per year sold at JKM and 3.5 sold at TTF. I put in prices of $12 for JKM and $18 for TTF. You can again put in whatever you think are the best forecasts, because we're talking about pricing in 2027 at this point. So it's quite a guess, this many years in advance. But this is what I plugged in as numbers here. That would get you to an average of $15 in revenue. These are after shipping costs, by the way. So this is what Tellurian would actually sort of get from these. So get when they're actually loading onto an LNG shipper. So that comes to a total revenue for Tellurian of just about $3 billion per year from the LNG volumes that they would own, right? And again, this is me assuming that the LNG volumes that the equity partner would own from their stake in Driftwood, that they would both, this would be sort of, it would just cancel itself out for Tellurian. It would not cost them anything, it would not make them any money. And so I didn't worry about it in the feed gas portion, and I didn't worry about it in the revenues, because I just assume, there's going to be some costs for getting the feed gas, presumably, but then, they're going to sell it at cost, collect a fee of whatever it costs them to actually produce that LNG, including the feed gas. And so this is kind of just not makes no difference on the model, right? None of these factors really matter because it just sort of nets out to zero. They're doing all of that work at cost for the equity partner. So that is my assumption here for the volumes that would be owned by the equity partner. Now going down to some of the some other bits here about the actual cash flow that all of those assumptions would come up to. This gets us to a total revenue per year of 5.09 billion dollars per year from the LNG, right? This is adding up what they get from the JKM and the TTF volumes. And then we have to subtract off how much they spend in feed gas per year. We have to subtract off the liquefaction and transport costs. This is directly out of their investor presentation. And then what do I have to? Oh, this is just this line here just converts it from MMBTUs to $1 billion per year, which actually I see what might be an error in my model. This might be looking at the total liquefaction costs, not just the cost for their 65%. I will correct this after. Actually, I think I should be able to do this real quick. So if I look here, yeah, this is 550 BCF for the whole. I'm sorry, fixing this in real time. Really what I'm looking for is 65% of that 550. Give me one moment. I will address this. 550, whoops, 550 times 0.65. Let's call it 360. Sorry about that. So that is fixed. All right, so their liquefaction costs per year in terms of billions of dollars per year, not just per MMBTU, would be $360 million for the volumes that Tellurian actually kind of owns rather than just carries through as sort of a net zero, because those are the volumes owned by the equity partner. Then I assumed SG&A of $300 million per year. All those get subtracted off, and that brings their total cash flow per year for Tellurian to about $2.9 billion per year. This is excluding interest on debt or any debt payments at all. This is just their, sort of, what would this be? EBITDA, I guess. Because this also isn't including any deductions. Sorry, not, oh my gosh, depreciation or amortization. Apparently I'm more tired than I thought. Apologize for that. And so that is their cash flow. Now, sort of getting to the punchline here of the net present value, right? The discounted cash flow model here. I put in assumed a discount rate of 12% for their future cash flows. And this number here, I assumed, this should not be underlined, I assumed that it was going to be 4.5 years until they actually start operations. And this, I think, is reasonable. Before in mid 2020, we were hearing that it was going to be about 4 years until they started operations. They were going to start operations in, at one point they said, Sharif had said Q1 of 2026. And I think if we carry that forward and say, well, there's been, at least a 6-month delay, 4 years from now even would be the end of 2026. If you add on even 6 months more from there, because they still don't have the financing locked down at this point. So if you say, well, they would start operations in, let's say about the middle of 2027, that's 4.5 years from now. So we would have to discount we would assume they're not going to actually see this level of cash flow from shipping liquefied natural gas until 4.5 years from today. So if you assume that, and then you have a 12% discount rate, then this line here sort of sums up the first 10 years of operations of Driftwood LNG and phase 1 for 10 years. So we are looking at 2027 all the way through to 2037. And this is again assuming the average prices that were called out up here, that these are the average prices over that 10-year period. And putting all that together, that would give us the net present value of those 10 years of cash flows of $11 billion. And so that sounds pretty good. You have to remember that there would then be, carried down from the project financing assumptions up ahead or up above. There were $9 billion of debt that went into this project. Therefore, if we subtract that off the actual equity value, right, the value for the stock would be, $2.1 billion. Divide that across all of the, my fully diluted share count that I use the assumptions up ahead. and then that gets you to sort of a fair value as of today of just a tad over $3 per share. And I put this number in just for fun. That at operations, they would actually be looking at cash flow per share of about $4.29, and that is generally a walk through the model here. Hopefully gives you an idea of what you can do here, what you can plug in, and what it's actually coming to, how it's working, right? It's just a net present value calculation here. There's a couple things that it does not take into account. A couple things I wanted to call out here. Well, mostly one thing I talk about a lot of. I just have a couple notes for myself, but the one thing is that this does not give any value to either phase one operations after the first 10 years, right? So there's clearly some value to that. And I didn't bother adding into this model, so I think the value would be above $3 per share from there. It sort of gets iffy in terms of how much do you want to, how far do you want to make assumptions for the future, right? If you want to assume some terminal value is usually what we would call it in doing discounted cash flow model for the operations in 2038 and beyond. Right now, I'm not giving any credit to that because, it really, after you discount things, 15 years into the future, the value of that really becomes pretty small in terms of what it impacts your final value here. But clearly there is still some value to that. And then the other bit here is this model right now doesn't give any credit to the rest of Driftwood, phase 2, phase 3, or phase 4, right? And phase 1 is less than half of the total value or the total capacity of Driftwood. And so that's something to keep in mind, is that, it's hard to value, right? What do we think even those future phases would be? So, but this is intended to give you sort of a valuation of just the phase 1 piece so that you can, reason through what is that worth, and then you can extend that to think about how much do I think that those future phases would be worth justifying even additional value to the stock. All right, so that was everything I wanted to cover. I see Transient Stacker has a question. Transient Stacker says, "I'm assuming phase 2 would be an increase in profit." Yeah, hopefully I just answered that. But yes, phase 2 would be even more. Phase 3 would be more. Phase 4 would be more. Right. So this is only telling you that this is a model for sort of the current net value as of today for the first 10 years of operations for only phase 1. Right. So there's that sort of additional optionality, that additional value that you would have from after the first 10 years of operations for phase 1, and then additional value from phase 2, phase 3, phase 4, right? And so this is what I'm looking at it and thinking, well, if they hypothetically, if they never got past phase 1, but if they can at least get phase 1 going, I think current value per share of $3 is a fair value for Tellurian stock. Again, maybe if you want to discount this even further because they don't have this lockdown, maybe you think that really warrants a much higher discount rate. Maybe you think there's only 50-50 shot that they're going to actually get all this done. Then that's meaningful. But I think that's something to consider. Ladder says, "I think they would also be adding more of their own gas to the mix as time goes on." Yeah. So my my assumption here of their gas production, I think, is at 400 million cubic feet per day. I believe is above what their current capacity is. I think I got that number from sort of assuming that they incrementally build capacity in over the next couple years. And this might be an undershooting it, but this is actually more than what they're currently producing. I can't recall. I'd have to see if I think they have it in here that their current third quarter, they are producing 125 million cubic feet per day. And I'm actually not sure if that, I guess that should include the acquisition here. They had a target for the end of 2023 in a prior presentation. I don't see it in here. But yeah, so I think that is partially taken into account. And the way it actually impacts this model is in bringing down the cost of their feed gas here, right? So if this number increased even more, that would reduce their feed gas costs even further. So that is how I have that factored in here. One fun thing to that I sort of was playing with the numbers and looking at, one thing to consider is this discounting of the future cash flows as this number decreases, right, as time passes, right, if this goes from, well, now we think if they close the financing and a year passes or a year and a half passes, and now it's only 3 years until we think the operations are going to start. Everything else, all the assumptions basically stay the same. I'm going to change this number from 4.5 to 3.5, and what you're going to see is that the discounted cash flow value is going to go up by 12%, roughly 12% to the roughly 18%, right? 12% to the 150% power, I guess it would be. But it is sort of a non-linear increase. Is not just that 18% increase in the equity value, right? The equity value, the value per share per this model actually would go up to $6 per share. If I change it to 2 years until operations start, it goes up to 8.43. Change it to 1 more year passes, and now your equity value, your value per share goes up to $11 per share, and that's because the overall net present value of the cash flows go up by 12%, but the value of that the amount of that debt doesn't change, right? So the overall amount of the net present value of those cash flows increases by 12%, and the chunk that we're chopping up for debt stays the same. And so that means the equity portion, which is small if we look at it today in a net present value calculation, actually grows quite a bit as time goes on. So hopefully that made sense. If that didn't, let me know. All right, Transient Stacker, what do you think about India's anger at Germany for not supplying them with LNG? Would that give them more of an incentive to invest in U.S. LNG companies like Tellurian? I think so. I think it comes down to them having kind of better contracts, and I think that's something that with the U.S., at least historically, I think folks trust U.S. companies to follow their contracts pretty strongly. And I read some stuff. Sorry, I've been not had as much time as I historically have had to follow stuff, but although I did read just a bit about that. And I would imagine that's something that everybody who's signing new deals is thinking about in terms of how they structure those deals and how they write this. But I think it's absolutely it's got to be at least a factor towards them thinking about diversifying their partners, let's say. Ladder says, I think Tell is at least a back pocket option for them. Yeah, I agree. Defcon 2 says, it is true that Tell has around $600 billion in debt. If so, when is this debt due? So they do have the convertible. Let me pull up their Q3 10Q. They have, this is their balance sheet as of September 30th. They have, right, so the current borrowings were 160 million, and then they had long-term borrowings, meaning not current, as 380 million. The vast majority of this is from their $500 million, if I recall correctly, in convertible notes. This is all due, I think, in 2025. I did a whole video about it, and sorry, it's been a bit, so I don't have all the details in my head. If I go to their convertible, so they called it current, but it's not actually current, I don't think. I don't think they have to pay back the principal until 2025. We issued and sold $500 million. I think they made it current because it could be converted on an earlier basis. Yeah, so on each of these dates, May 1st, 2023 and May 1st, 2024, the holders of the convertible notes may redeem up to $166.6 million of the principal. Okay. So it looks like those could be current liabilities. Say redeem. I guess a redeem is, maybe I'm not smart enough. I don't know enough about the sort of the language here. I don't know if redeem means convert or if that actually means get paid back. I assume that would mean they get paid back, although again, I am not a financial professional, so I actually could be wrong on that. All right. Ladder says, do you mean million? Yeah. Good call. Yes, $600 million. And so it's actually, I think, more like 500 I guess they have it right here. Yeah, it is closer to 600 if you round it, right? So they have 500 from the convertible debt and then about 60 in their in their bonds, their Tellurian Telz, and that's due 2028. So that, I think, hopefully that answers your question. Yeah, Transient Sacker says that is Telz, right? Yeah, that's their 2028 notes are the trade under the ticker Telz. You can see those. I think last time, I haven't checked them recently. Last time I had looked, they were trading at, thanks Yahoo. They're trading like $18, which $19. They're up a bit. This is interesting. If you want something that's lower risk than Tellurian stock, well, you could argue if it's higher or lower risk, but you can make some money on this, right? I think you'd be getting $1 per year, right? Is that right? Because these are $25 par value. Is that right? $25 times 0.0825. No, that would be the premium per year. So currently these would be paying out about, if I did my math correctly, 10%. And then you'd make some appreciation when they finally get payback in 2028. Make 31% by that point. So, yeah. DEFCON 2 says, I see. Okay, well, that's due a long time from now. Wonderful. Yeah. Yeah, these convertible notes, I'd have to go back and read. For some reason, I was thinking that they didn't get paid back until 2025, and it was actually the ability to convert at these points in time. But maybe, as I'm saying it out loud right now, that sounds like a strange agreement, but maybe it was. I can't recall off the top of my head. Ladder says, is no news good news? They used to talk a lot, but they seem more close-lipped. I don't know. I think the lesson we learned is that all that talk wasn't necessarily. Sorry, the lesson that I learned was that all that talk wasn't necessarily good news. I don't know if no news is good news necessarily. I think now's it's a very interesting time, right? In terms of, I think liquidity is low across, just in general is lower than it was last year for for multiple reasons, right? Just because the general economics are getting worse and so people are being more cautious. And then also you have actual interest rates, Federal Reserve interest rates going up, and so that puts a damper on things. So I don't know. Like I'm not any more pessimistic necessarily because we're not hearing a lot. And again, I've called this out before, that the fact that they have an operating company and they are, they could at least be, quite cash flow positive right now as a gas producer if they wanted, right? It's not on the scale of Driftwood profits, but, they have an operating company underneath all of it. So, I'm willing to be patient. I'm personally willing to be patient for the company. And I'm not super worried about it. But yeah, in terms of is no news good news, I don't know. Depends how optimistic you want to be. So, all right, that covers everything that I wanted to go through today. Again, this model is available on the in the description of the video, and so if you're interested in that, feel free to take a look, make a copy, and play around with the numbers yourself. So, I am gonna haul off pretty soon. Let me at least try to get through one more thing. Ladder just said, also, I haven't really seen anyone talk about this, but what about the proposed windfall taxes for gas and oil companies in the U.S.? Yeah, it's a good question. I haven't followed it very closely. I wasn't sure. I haven't followed very closely, so I'm going to just say that as of right now, I don't know enough about it to have an opinion. I think if they did actually, if there is some tax going through and that's going to really hit the oil and gas companies, then yeah, that might be even a further damper on investments, right? Because anybody who's like part of the value proposition for Tellurian for these companies, right, is that they would be able to sell at TTF and JKM, right? So sell at these international prices, which could be much more lucrative than selling the gas here at home. As we saw this year, with TTF prices went crazy, and folks want to capture that upside. I think it does certainly it changes the calculus if it's on the table for, special taxes to say, hey, you're just making money hand over fist. We're gonna impose extra taxes on you to take some of that, right? It takes off some of the upside that they could potentially get, from the investment that they would put into Tellurian in order to have those that exposure to those international LNG indexes. So sorry, I don't know that much, but about the proposed tax, but I think that could actually be a material negative for Tellurian. It actually, I think, would be a disincentive towards that model where they actually sell at the international pricing, because it takes away all of the upside, and sort of incentivizes more of the tolling model, because your profits are going to be predictable. Sort of lower risk, lower reward approach, but your upside is not going to be quite as capped from the tax. All right, one more thing. Ladder says, another thing isn't what Tell really wants is for someone like India or Pakistan to invest into Driftwood, get them to commit like $4 billion or whatever it is they need for FNTP. I mean, that's certainly an option on the table. I think there was a recent video where Sharif was talking about this, and he kind of said, well, we have sovereigns like that, countries that want to do this, and then we also have some of the oil and gas producers that want to be able to sell internationally, and it's sort of let's see who makes a move first. Again, this is a place where you have to kind of have trust in management to some degree, and I know a lot of folks have lost that trust because of the past couple months, or the past year, I would say. But the macro, I think, is still there, and I know Sharif likes to say that a lot, but I mean, I actually share. I believe him. Let me say that, right? I don't believe him because I just put blind faith in him and look at his past achievements, but I do agree with what he's saying, and so I share that belief. I think the macro is supportive of this, and the incentives seem like they're there both for countries like India or Pakistan and for the U.S. oil and gas producers. So I'm still invested. That's sort of some of my thinking as to why I am. All right, I really got to hop off now. Thank you all for joining. Thank you all for the comments. This is a great conversation. I love it every time I actually got able to get on here and have some conversation going. I have a lot of fun. So thank you very much, and have a good one.